Hi everyone. Okay, so hi everyone. I am Muskan Gupta from CFO Advisory at KPMG. I hope you're all having a wonderful weekend with lots of learnings. So today I'll be taking a session on financial ratio analysis and consolidation. It's going to be a little long session, so I hope you've all had your lunch. One request, please keep a writing pad and a pen handy because there'll be times when I'll ask you to solve questions. So let's just keep everything in place. Also, let's try and make this session more interactive. Please ask your doubts in the chat box, and whenever I ask question, I expect you to answer and be with me. If there's any point you feel that I'm going too fast, you can stop me then and there, and we can revisit the topic, or maybe at the end. Okay. So please make sure that you're interacting, and let's keep the chat box a little more lively. So I think we can start with the session. We'll do ratio analysis first, and then we'll move on to consolidation. Okay. Can you guys see my screen? Guys? How
yes,
can
your
I
screen.
see? Okay, so now help me here. If there's somebody who's typing in the chat box, how will I see that?
On the right of your screen, there is a chat window. You'll have to click there.
Right, so it's okay. Give me a second. Okay, so you can see my screen, right? Okay, I think we can. So let's just start. Okay. And before I'd like to know if everyone knows the meaning of the terms individually, right? So like we can make sense of the solvency ratio if we know what solvency means and what a ratio is. So I suppose that we have had a session yesterday on ratios, and most of you must be knowing what a ratio is. So quickly, let's have answers what a ratio is. It's very easy, and I hope that most of you know what a ratio is. Let's just answer. Okay, so we have no response as of now, and I'm hoping that somebody, at least one person, will know what a ratio is. Guys, please answer.
Ratio is actually a mathematical way to compare. What I
So what is the ratio? I just want a basic answer. It's basically anything that is expressed in the form of P by Q, right? So you basically, it's a rational number, and you express it in the form of P by Q. One thing is that you need to know that your denominator cannot be equal to 0. That's exactly what I was looking for. Anyway, moving forward, let's explain the term solvency. So, any idea what solvency means? Okay, this question, let me give you a case, okay? I'll describe a situation to you, and probably then we'll know what solvency is. So supposingly, I take a loan from bank to open a restaurant, and say I take a loan of rupees 10 lakh that I have to repay in 10 years. Fine. I repay. So this 10 lakh has to be paid annually. So there are installments that are made. So say I make 4 annual installments, after which I realize that my not only is my restaurant performing no, not performing well, I don't have any other stream of payment to repay my interest as well as my principal amount. So what happens is after fourth installment, I'm unable to repay my loan. I declare myself insolvent in technical terms, right? So it was a pretty direct case, and I think you'd know by now what solvency is. Guys, quickly, I won't move forward if you're not answering, if you're not interacting. Okay, so we have from Abhishek. Right. Oh, you're on the right track. Yeah. Okay, so basically, solvency is the ability to repay debt. Okay. Now, I want you guys to tell me some recent examples or some real life examples in general that where you felt there was insolvency involved. One case I'll tell you is Vijay Mallya. It's a pretty known case and everybody knows about it. We know what happened. So let's just share real life examples. If there's anybody who knows, please type in the chat box and please mute yourself. Mute yourself and let's keep the chat box interactive.
Subrat Roy, Sahara.
Can you please type, I don't want any disturbance. Just mute yourself and type it in the chat box. Everyone. Right, we have body, yes. Any more? Yes. So I think it's only Abhishek who's interacting here. Guys, please answer. Yes. Perfect, Sarit. Okay, so moving forward, I think that's enough. So as I said, solvency basically means the ability to repay your debt. Okay. So let me ask something. Okay. So in balance sheet, I think everyone knows the basic structure of a balance sheet. It has two sides. One is the asset side, one is the liability side. So if I tell you my liabilities are more than my asset, what situation is this? Am I being solvent? Am I being insolvent? What is the situation? When liabilities are more than your assets. Quickly, guys. Liabilities are more than asset. Okay, so I have one answer. Any more? Hmm. Okay, so in general cases, in usual cases, this means I am insolvent because if my assets are lesser than my liabilities, I do not have enough stream of income to repay my debt. That is being insolvent. Now, if my assets are more than my liabilities, does that necessarily mean that I'm solvent? I'll repeat myself. If my assets are more than liabilities, does that necessarily mean that I'm being solvent? quickly, guys. Right. So Abhishek says no. Sarit says not necessarily. Yog says not really. Right. Right. Perfect. So basically, if my assets are more than my liabilities, in the long run, I may be solvent. In the short run, I may not. Because, yes, exactly, Pooja. So say I have assets which I have machinery, I have plant, I have other things that cannot be easily liquidated, right? So I am unable to repay my debt in the shorter term. So this is a very important concept that you need to understand, that assets more than liabilities does not necessarily mean that you're being solvent. Okay, I think you're clear up till now. So we've understood what is a ratio, we've understood what is solvency. Now let's combine the two terms. Let's see what is a solvency ratio. So basically, solvency ratios are the ratios that help us determine the solvency of a company. That is, they help us ascertain the financial position of a company. Okay, the solvency ratio is basically helping us to determine the financial position of a company. Understood? Okay, so one thing that we need to understand before we move on to solvency ratio is to understand the capital structure of a company. Okay, so what is capital? What is capital in a business? What is capital in a company? What is it?
Owner's fund.
Right, Aditya. But again, I request you to please use the chat box. Yes, but you're perfectly right. It's the owner's funds. Anyone else? So basically, capital is the amount invested in the business in simple terms. Okay, I'll give you a technical definition. Listen to me very carefully and I'll repeat myself if it's not clear. Capital includes cash and other financial assets held by individual or a business and is total of all the financial resources used to leverage growth and build financial stability. Right? So basically, capital in simple terms means the amount that you invest in a business, and in technical terms, it includes cash and other financial assets held by individual or the business, and it's the total of all the financial resources used to leverage growth and build financial stability of the business. Am I being clear till here? Can I have yes in the, yeah, so okay. So now this is capital. Now, before moving to capital structure ratio, what is capital structure? I usually take terms by term and then I club to find the meaning of the entire term. So before moving to capital structure ratio, we've understood what capital is. Because Pooja has asked me to repeat the last part. Pooja, it was nothing. Basically, I was explaining what capital means. And in simple terms, as most of you also said, it's the amount invested in the business, right? But in technical terms, if somebody so in layman language, if you explain to any layman, you can definitely say the amount invested in the business. But just to be a little more professional, to have a technical definition in place, that's when I told you that capital includes cash and other financial assets held by the individual or the business, and it is the total of all the financial resources used to leverage growth and the financial stability of the business. Okay, it's a wholesome definition, nothing more. Right. Okay. So now what is a capital structure in a business? In a business, we're talking from business perspective. So what is a capital structure, guys? What is capital structure in a company? I'm waiting for a few answers. Yes, exactly, Sarit. That is my question. How is the capital structured? So how is it structured? Tell me. Right, right. So basically, capital structure means your sources of finance for the company. Now, supposingly, if you suppose, let's take an individual example before moving on with the business. Suppose I, as an individual, want to open an ice cream parlor. Okay, so there'll be a lot of costs that will be involved. I'd probably also have to hire somebody to help me with running of the business. So all these costs have to be borne by me. Now, this cost, I will finance this cost in multiple ways, right? So perhaps let's say the cost of running an ice cream parlor or setting up an ice cream parlor is 5 lakh. Okay, I have 2 lakhs with myself, right? The bank agrees to give me 1.5 lakh of loan, and the remaining amount I ask my parents to help me with, right? So I am not. So what are my sources of finance? My sources of finance are self, bank loan, and family members, right? So for a company, when it wants to raise money, it looks for sources of finance, and those sources comprises the capital structure of the company, right? And as most of you have also said, capital in company is basically very broadly divided into two categories: the equity and the debt, right? Equity, and I'll just give you a brief about these. Equity is the owner's funds. So if I'm investing rupees 2 lakh in my company, that is my fund, right? So equity is also known as the shareholders' funds. And who are the shareholders? Shareholders are the owners in the company by the amount of shares held by them, right? So say in my company, which is worth 5 lakh, I invest rupees 2 lakh, and there's somebody, say a friend of mine, who says that I'll give you 50,000. His ownership is, he is also owner of the company now. He and I am also the owner, but our ownership rights will be decided by the amount that we invest. Because obviously he's investing 50,000, I have 2 lakh. So our ownership will be decided according to the invested amount. That is equity. Equity is owner's funds. The second broad category is debt. Debt, as we all know, is the loanable fund. Is the fund that you take on loan. Other major difference between these two is on equity. When you become a owner of a company, you earn dividend. Okay, so the return on my investment is the dividend here, whereas in debt you earn interest. So say a bank gives me loan, I give bank the principal as well as the interest amount, right? So what is the earning for the bank? It's the interest, which is what you earn on a debt. Lastly, in equity, these dividends are irregular. So the company does not have the obligation to give dividend to its shareholders on a regular basis. Whereas the repayment of interest is regular. You will have to repay the interest irrespective of your financial position. That is, whether you make a profit or a loss, interest has to be paid. Am I clear till here? Quickly summarizing, capital is the amount that you invest in a business, broadly divided into debt and equity. Equity is the owner's funds, debt is the loan funds. On equity, you earn dividend, in debt, you earn interest. Dividends are irregular, interests are regular. Okay, so now let's do a little exercise. I'll ask you, now I've given you a little brief about equity and debt now. I'll give you 4 cases, and let's see if you are able to determine which is higher for what, for which. Say, please take your writing pads and mention and make a table, write debt and equity. And you have to distinguish between the both of them on the basis of 4 factors. One is the cost of raising funds through debt and equity, which will be more. Second is the control. Who has more control in debt or equity? Third is the return. Debt or equity, higher return kahan hai? Lastly is the risk perspective from the company as well as the investor in both debt and equity. Just mention whichever will be higher according to you. So distinguish between debt and equity on the basis of cost, control, return, and risk from company as well as the investor's perspective. I'll give you 2 minutes. Okay, so you're asking me to repeat, fine. So as I mentioned, capital is the amount invested in the business, broadly divided equity and debt. I give you a little brief about these two structures. Now I'm asking you to distinguish between debt and equity on the basis of 4 factors. First, cost of raising funds. Second is the control. Third is the return. And fourth is the risk from company's perspective and the investor's perspective. Just mention whichever is going to be higher in which case. Take 2 to 3 minutes, think about it, and let's see if we have the answers. So we are distinguishing between debt and equity on the basis of cost, control, return, and risk. And let me know when you guys are done. Just quickly mention which is going to be higher according to you. I'll disclose the answers. Just keep it to yourself. Keep it to yourself. And just cross-check when I disclose the answers. Not a problem. Just let me know when you're done. I'll give another minute. Okay, I think let's move forward. So first factor was cost. And as I have two answers here and Aditya also. Okay, so Aditya says equity does often provide more interest payments. Okay, so first is, I think most of you got it correct. Cost is higher in equity and lesser in debt. And I'll explain why. So say I want to take loan. I go to the bank directly and ask for loan. I give the collateral and I get the loan. But if I have to look for owners in a company, right? If I have to look for people to ask and take ownership of the company, it's not going to be an easy task, right? I don't know who would be interested in my business. I don't know who will be interested to invest in my business. And so the flotation cost, please note the word flotation cost, exists in equity. What is flotation cost? Is the cost you incur to get the word spread. Okay, so say I'm giving an advertisement in the newspaper that company XYZ is coming out with these many shares and looking for shareholders. That is my flotation cost. You don't have to incur any such cost in that scenario, and hence the cost of raising funds through equity is a lot more than raising through debt. Am I clear? Okay, so that was cost. Next is control. So I mentioned the flotation cost because I want you guys to know specific answers. So if somebody asks you why the cost is more in equity, you should know that it is because of the flotation cost that you incur. Okay. Next is control. So it's a very logical answer. Bank cannot interfere in my day-to-day business of of operations of my business. But somebody who owns my business, who's a co-partner with me, will be able to, right? So loss of control or the control dilution is more in equity as compared to debt. Understood? Okay. Next is the return. As I mentioned, on debt you earn dividend. On uh, sorry, on equity you earn dividend, and on debt you earn interest. Debt gives you interest which are regular, dividends are irregular. Now, if supposingly as a shareholder or as a investor, potential investor for company XYZ, there are two streams. One is to buy a debt or to buy a share, right? And I know if I buy a debt, I'll get regular stream of interest. So it's a fixed payment that I'm getting. And in dividend, I may or may not get my return. Why would I even consider dividend when I know it's not regular? It's because the return is usually higher than interest in most cases. So the return is more in equity, less in debt. Dividends are usually higher, in most cases are higher than the interest. And that is what makes equity a little more attractive to the potential investor. Okay. Last factor was risk. From the company's perspective, as a company, if I've raised funds through equity and through debt, the company may or may not pay the dividend, right? There's no fixed period where I have to pay my dividend. So I am relieved to some extent. Whereas if I've taken loan and I say make a loss this year, I'd still have to repay the interest on the loan that I have taken. So it's a bigger burden, the risk is higher. Thus, risk from the company's perspective is higher in a debt case and lower in the equity case. And vice versa happens in the investor's case. So my risk from investor's perspective is higher in equity, lesser in dividend because I don't know when I will earn the dividend. So these are four factors. I can repeat if you want, but just let me know if I'm clear up till now or not. Otherwise, we can go back and repeat this. Uh, I don't remember the last two lines, but I'll take the risk topic altogether. So basically, risk from the company's perspective is higher in a debt scenario as opposed to equity scenario because I have fixed obligation to repay the interest on the loan that I have taken as opposed to repaying the dividend because it is irregular and does not have a fixed period to repay. So if I make profit, it's not my obligation to share the profit that I've earned with the shareholders. I may or may not. Whereas with interest, even if I make a loss, I'll have to pay the interest. Okay, so risk consequently is higher in debt as opposed to equity from the company's perspective. And just turn the table from the investor's perspective, it's higher. I have higher risk in equity because I don't know when I will earn dividend as opposed to interest, which is I know is fixed and will come to me annually, monthly, or whatever the period is. Okay, so now we know what is capital, we know what is capital structure, we know the basic factors on which you can distinguish between debt and equity. So the question is, why does company have both these factors? As we saw that equity looks a lot more attractive, right? Because the company does not have to pay the equity shareholders regular. But in debt, while my cost is low, the control is less, return is also less. So why can I not, as a company, choose only one of these components? I think I gave the answer when I was explaining. So I think it was, so just to be clear, it is because each of these components have their own pros and cons, right? So while equity may be much more beneficial in terms of risk from the company's perspective, whereas in debt, my cost of raising funds is less. One example. So, right, so each component has its pros and cons, and there's a trade-off for the company between the two factors to minimize the cost of capital, right? So how do you determine how much debt and equity? You'll have to take a combination of both so as to minimize the cost of raising capital in a company. Generally, in industry perspective, the optimal ratio is debt to equity 2:1. So debt to equity ratio should be 2:1, but this is not a stringent ratio, right? So it will vary industry to industry, company to company, and so it is flexible. Okay. Are we clear? So the company has to balance its capital structure in a way that it gives it the maximum return at the minimum cost. Now we finally come to capital structure ratio. Yes, debt should be 2 times the equity because debt equity ratio is 2:1. And as I said, it's a flexible ratio, but a generally accepted ratio is 2:1. Okay, so now we finally come to capital structure ratio. So what is a capital structure ratio? It's basically a ratio that tells us about the capital structure of a company and which helps us to determine the long-term financial stability of the business. Okay. One second. Okay. So this is capital structure ratio. Now, let's move on. Okay, okay. We have 5 capital structure ratios that help us determine the solvency of a company. The first is debt equity, second is debt to EBITDA, debt to capital employed, and then the two are interest coverage ratio and the debt service coverage ratio. We'll take them one by one. And the first one that we need to know is debt equity. Right. So as I mentioned, the debt equity should be 2:1. The ratio is calculated as the name suggests, total debt divided by total equity in the company. What is equity? Is the shareholders' funds. Or equity can also be calculated as net assets. Okay. What are net assets? Asset minus liability is equal to your equity. I think this is a general accounting equation which you all should know. And so that's how you calculate equity, which is the shareholders' funds, and total debt is all the debt in the company, which includes short-term as well as long-term debt. Okay. So if you see the slide, it says if the debt equity ratio increases, the risk increases. Why? Because understand, debt upon equity increases can be two ways. One, debt can increase or equity can fall. In both these cases, the ratio will increase. So if my equity is falling, by comparison, my debt is more, which is also my first case, that if debt is more, then the ratio will be more. So as we also did this exercise earlier, with debt, the risk from the company's perspective increases, right? So that's what is mentioned here. The risk increases, but the cost of capital falls because I'm not incurring any flotation cost, right? So this is the debt equity ratio. Shall I move forward? Can I move forward, guys? Yes, okay. So the next ratio, we have debt to EBITDA. What is EBITDA? Earnings before interest, tax, depreciation, and amortization. Is it clear? EBITDA is earnings before interest, tax, depreciation, and amortization. Okay, so what is EBITDA in layman term? It's the total earnings of the business. It's the total earnings of the business with from which you will pay your taxes, your interest, your depreciation. So it's the total earnings of the business. And as a ratio, you calculate taking debt as the numerator and EBITDA as the denominator, right? So it's a relevant ratio when you're looking for acquisitions. Okay, so if I say have to acquire company Z, I will look at the debt equity ratio as to see how much is the debt to understand the capital structure basically. I will look at the debt to EBITDA ratio to see how much is it even earning before it is paying out anything, right? So I have debt say 10. Okay, no, let me ask you. Supposing my debt to EBITDA ratio is 10. What does this mean? If my debt to EBITDA ratio is 10, what does that mean? Yes, my debt is 10 times my earnings. Right, sir. That's exactly what, and that is a very useful ratio when I'm looking for acquisition, when I'm lending money, and also to estimate profitability of the business, right? Because you make profit from your earnings, right? So when you compare the amount that you have to pay, that you have to repay, as opposed to your earnings from which you will get your profit, it's very important to have this ratio in place to be able to determine the profitability of the business. Okay. Am I clear till here? Okay, so the next is, okay, I'll give you a second, just quickly read through this. Not very, very important, but just for your reference. So debt, if you see, debt includes bank loans, trade payables. And if you see the first bullet point, this ratio is helpful in management decisions and can be used by the company interested in investing in a takeover bid. That is exactly what I said, acquisitions. Besides, the ratio is also helpful for potential buyer in estimating the profitability of the company. Okay, so let's move forward. Now we have debt to capital employed. What is debt to capital employed? As the name suggests, it is debt is to the capital in the company. What is capital in the company? The equity and debt. As we just learned, capital is equity and debt. You compare debt. So basically, what is this ratio telling me? This ratio is telling me how much debt is there in the overall capital of the company. Okay. So as it says, it measures how much of the company's or the firm's asset base is financed using debt. Okay. So if debt to capital increases, it basically means that debt intensity increases. So if my debt capital employed is, say, ratio is 5, what does that mean? Is it possible? Is it possible to have debt to capital employed as 5? Can I have more answers? Can my debt to capital employed be 5 or 10 or say 100? No, right. It always have to be less than 1 because less than or equal to 1. If say there's no equity, yes, perfect, just a moment. So if my equity is 0, then my ratio is going to be 1. And if there is equity, then the ratio will be less than 1. Okay. So 1 second. Just let me know if you can see my screen. Are you able to see my Excel file? Okay. So I have a balance sheet here. Let's say of Reliance Communication. We have equity, trade payable, and long-term loan. And in assets, we have cash and machine. Let's calculate the debt equity ratio quickly. Let's calculate the debt equity ratio and the debt to capital employed together, both. Calculate the debt, calculate the equity, calculate total capital in the company, and quickly calculate the ratios then. Do we have any answers yet? Guys, somebody, has anyone got the debt equity ratio yet? Let's have answers for debt equity ratio first. So I'm getting different answers here. So let's calculate that equity ratio. Okay, so what is my debt now? Trade payable is my debt. And long-term loan is my debt. Am I right? No, debt is not just 180. It's plus 50 also because it's long-term as well as short-term debt. How much is it? Right? What is the equity? It's directly given to us 120. Right? So this divided by this, that's exactly what we do. We have the answer as 1.9166, approximately 1.9. Now let's quickly calculate the debt to capital employed. Debt, as we know, as we calculated here, is 230. What is the capital employed in the company? Total capital employed is my debt plus equity, which is my 350. So now let's divide this divided by this. Sorry. We have 0.657. Okay, so I think most of it on the same line. So we have debt equity ratio is 1.91 and we have debt to capital employed as 0.65. Okay. Now I'm going to stop for 5 minutes or let's say 3 minutes and just go back and think if there was anything that was not clear. I'll go back to the slide and then we'll move to the coverage issues. So we've covered solvency ratio, 3 solvency ratios, debt equity, debt EBITDA, and debt to capital. We also learned about capital structure, debt equity, differentiating factors. So yes, Abhishek, trade payables are debt because money is yet to be paid, yes. It is a debt one because it's the amount that you owe, right? So trade payable, what happens is supposing I sell you goods, okay? I sell you goods and I say that I'll pay you back in 3 months from today. So I sign a check or say I sign an agreement with the other person that I will repay you a sum of XYZ 3 years hence, right? So it's the amount, so that trade payable is the amount that I owe. So it's a liability for the business. Optimal ratio for debt to capital employed, you tell me actually. So we know that debt to equity is 2:1. Using those numbers, what do you think should be the ideal ratio for debt to capital employed? Think a little. If my debt to equity is 2:1, then what should be the ideal ratio for debt to capital employed? Right, 2:3, which is 0.6 around. Again, there's no norm about it. And this is what I derived from the net debt to equity ratio. So I'm not sure if this is optimal ratio or not. But logically speaking, if my ideal ratio for debt equity is 2:1, then my debt to capital employed should be 2:3. Okay. So if we are clear, then we can move forward now. Shall we? Let's quickly type in yes. Okay, so the next two ratios in capital structure ratios are debt service coverage ratio and interest coverage ratio. Okay, so what does these ratios basically mean? So the first on our list is interest coverage ratio. It basically means, is the company able to pay its interest, that is the interest it owes on debt, from its current income? Okay, so what does this ratio basically mean? It tells us it tells us about the company's ability to pay interest on debt with its total income. So if you see the formula, it is EBIT upon total interest expense. So denominator is interest, numerator is the earnings, right? So this ratio tells me if my earnings are enough to pay my interest. If this ratio is high, naturally it means that my earnings are more as opposed to my interest, right? So interest is what I owe, earnings is what I have. So if the ratio is high, it means that my earnings are more as compared to my interest obligations. And so the risk from the company's perspective falls. Understood? It's a very, very, very important ratio, and most companies look at this ratio in day-to-day operations for acquisitions, for investment. So this is a very versatile ratio and is used widely in the industry. So you should understand what is interest coverage. It's basically if I have debt, if I have loan, I'll have to repay the interest. Does the company have the capacity to pay that interest with its current income? That is what this ratio is exactly about. Okay. Next ratio that we have is debt service coverage ratio. So basically this ratio means, or this ratio tells us about the company's ability to pay the debt from its earnings. As simple as that, right? So it basically tells us about the firm's available cash flow to pay current debt obligation. So while the previous one was only concerned about the interest on my debt, this is concerned about the entire debt, which I have obligation to pay in the current period. Okay, so interest coverage ratio is concerned about interest that the company is liable to pay, whereas in debt service coverage ratio, it is about the debt that the company is liable to pay in the current period. Okay, just quickly giving you a minute to glance through the slide. Right? So it's basically saying exactly what I had said. Okay, so Aditya wants me to go back to slides. Okay. So this is the interest coverage ratio. Let me know when I can move forward, Aditya. And if there's anything that I want to explain, I have to explain, just let me know. So if you see here in the denominator, we have interest as well as the principal repayment. Here we only had the interest, while here we have interest as well as the principal amount that I have to repay. That is why it says debt coverage ratio, because I am covering the entire debt, which is my principal as well as the interest. Okay, so understand it this way. I've taken a loan and for 2 years, say 10,000. I have to pay with interest, say 10% interest. So कितना होएगा? 10,000 pay, 1,000 interest. So I have to repay 11,000 after 2 years. This I have divided into 2 installments. So 11,000 divided by 2, 5,500 each year that I have to pay. Okay. So now the company has to pay how much? 1,000 rupees as interest, which is divided into 500 rupees each year. The interest coverage ratio will be concerned about that 500 rupees they have to pay for this current period, for this current month. Here my current period is a month. Whereas a debt coverage ratio will be concerned about entire 5,500. That is my principal 5,000 plus the interest 500 that I have to pay for this current month. Is it clear? So the numerator remains the same. It is earnings before interest tax. Here we have net profit, and then we're adding back depreciation, amortization, and interest. Same thing that we had there. Only the denominator changes. Here we have interest. Here we have interest as well as the principal payment. So in my example, 500 rupees is the interest, 5,000 is the principal repayment. I hope it's clear now, Sarit. Okay, so we're on this slide and I hope you've read it. So if you understood the ratio, you'll understand all these points very, very easily. Okay, so with this, we complete the capital structure ratios. We've covered 5 ratios today. Debt equity, debt to EBITDA, debt to capital employed, then debt service coverage ratio, interest coverage ratio. Now, supposingly, I tell you a company has debt equity ratio as 10, right? What should the company do? If debt to equity is 10, what should the company do? How can it position its financial position? What are the ways? Okay, so what I basically mean is if debt by equity is 10, which is debt is 10 times my equity. I can A, reduce my debt, or I can increase my equity, right? Both of these can happen. So if I reduce my debt, how can I reduce my debt? I can sell off my, guys tell me, how can I reduce my debt? One way is to sell off my assets and then repay my debt. That is how I can diminish my debt, right? So there can be multiple ways to improve your solvency ratios. So one is selling assets to reduce debt, reorganize your business structure, increase owners' equity, reinvest money in assets, avoid taking new debt, and improve top line numbers. Okay, so these are the some ways how you can improve your solvency ratios. Giving you a minute to recap everything. If there's any slide that you want me to go back to, I can do that. Just let me know. Okay, I'm giving you a minute to just sit back and think what we've discussed up till now. Should I move forward or do we want to recap something? Guys, please tell me in the chat box. Should I move forward or do we want to recap something before we move forward? Array, somebody.
Muskan, I'm so sorry to interrupt. What is this sixth number improved top line numbers?
Basically, okay, so it is a little technical and I would suggest you to not go in detail, but Basically, give me a second. How do I explain? So basically, as far as my knowledge is concerned, what happens is this basically means improving the revenue of the business. I'll be a little more honest with you. I'm not too sure about this, but as far as I think I've read this topic. It's about improving the revenue of the business. But if there's anything else, I'll get back to you. But for now, just understand it's about improving the top line. So basically, the company mentions the revenue on the, like if you see the P&L of a company, the revenue is the topmost thing, right? So here I'm not sure what it means exactly, but improving top line numbers in general cases is improving the revenue. So yeah, so top line is revenue. Yeah. Okay, so we have somebody asking about floating cost. So floating cost, just understand. So if you are very, very interested in stock market, then it's a different scenario. But for a layman, you need to understand what the meaning of floating cost. It basically flotation cost is the cost that the company incurs to spread a word about its um, share, about its IPO. Okay, so if the company is raising funds through issue of new shares, then it will incur advertisement cost, right? As I told you about the newspaper advertisement, and it will have to say any other means that it resorts to. It gives advertisements in the magazines, or it uses social media to get the word across. So all the costs that you incur before issuing the equity shares, that is floating cost.
Muskan, actually, I asked about the floating cost, and sorry,
Yeah.
I'm like, uh, I was not able to explain my question in the chat box, तो इसलिए मैंने
हाँ जी हाँ जी,
unmute
no
किया.
problem, family.
Actually, see, जैसे अभी IPO आया बर्गर किंग का, तो बर्गर किंग इज a well-known brand, तो I don't think कि उसके लिए कोई flotation cost उनको देना चाहिए. As far as my knowledge, Google also hasn't paid any flotation cost to any of the investment banker, as far as my knowledge, because I have heard in one of the classes of Ashwath Damodaran. So
Okay, so okay, I totally understand your question, and I understand where this question is coming from. So, see, what I was talking about, the advertisement cost, is one aspect of flotation. Okay, this will also include the legal fees that the company has to pay for flotation. Oh, so for IPO, legal fees comes here, the registration fees for going public. So, like, there are a lot of back end expenses that the company occurs before actually revealing its IPO, right? So all this is included in flotation cost. So as far as Google is concerned, perhaps it did not incur any cost in advertising its IPO, but there are a lot of legal fees that are involved for issuing equity to the public. All those costs
okay,
are part of flotation.
okay.
Okay, so anyone else? Are we good to go? Guys, please type in yes or no. Okay, so I have one yes. Should I take it forward? Okay, so I have two yes, and I'm not sure if they're speaking for the entire batch, but um, I'm not sure. Is there something that's troubling anyone, or if there's something that you want me to go back to? Trust me, guys, I'll be very, very happy to go back and explain anything if it's bothering. Okay, I see no more responses, so let's move forward. Okay, so the next topic that we have is the valuation ratios. So while we covered solvency ratios now we have valuation ratios. And before moving forward, I hope everyone knows what the word value means, right? And consequently, you can derive the meaning of valuation. So let me ask you one question. Okay. Suppose I am selling you my company for rupees 50. Should you buy it or will you buy it? I am selling my brand new company for rupees 50. Or say I've been in this business for last 10 years and I'm selling it to you only for rupees 50. Only rupees 50. Will you buy it? Guys, please answer. And trust me, I'm not moving forward if you guys are not answering. I'll repeat the question. I've been in a clothing business for last 10 years and I'm selling you my company for rupees 50. Only rupees 50. Will you buy it? Three people have answered. Can I have more responses? We are a group of 10 people and I'm seeing only three people answering. Can I have the remaining at least two more people to answer this question? Is everyone tired? I don't see a lot of responses. Initially there was Sarit, just Mohan, and a few others who were also answering. Guys, can I please have have your answers here? Okay, I think they're not interested. Let's move forward. Okay, so coming back to my question, it was selling my company at rupees 50. So on the first glance, it looks like a good deal, right? And as Pooja has also said, I will buy it for rupees 50. Because what is rupees 50? It's too cheap for a company, right? So you probably buy it. However, what if my company has been in the business for 10 years but has been making losses all these years, or has been making losses in the last 3 years? So while the value of my company is in negative, you're buying a company that gives you losses for rupees 50. It is not a good deal. And as very rightly mentioned by Aditya and Abhishek both, you will find out the value of the company first. You will find its worth. You will use the valuation ratios to get its worth. And that's precisely why we need valuation ratios, because you have to know what the company's financial position is. How much is it worth? Okay. Okay, so next slide. Okay. So valuation ratio gives us an insight of the company's share price, which is basically a representative of the company's standing in the market. And we can find the valuation ratios using these ratios as mentioned here. First is the price book value ratio, price to earnings ratio, EV to EBITDA, and price to earning to growth ratio. Okay, so we'll take them one by one. The first that we have here is, okay, so before moving forward with these ratios that I mentioned here, we need to understand a concept, okay, which is EPS. So what does EPS stand for? It is earning per share. How do you calculate EPS? Does anyone know what is EPS and how do we calculate EPS? Right, so EPS is the earnings per share. That is, how much am I earning? How much is the return per share? Right? So the company, say company X has 10 shareholders, right? It makes a profit of rupees 100. How much is each person earning, or what is the earning per share? Right now, I've given you blank figures of 10 shares and profit after tax as rupees 100. So now, as a shareholder, suppose I am a holder of one share. What is it that I'm earning? Those 100 rupees will be divided equally among all 10, right? So 100 rupees divided among 10 shares will fetch me rupees 10 per share. So if I'm owning, say, 5 shares, my earning will be rupees 50 total earnings. What is my earning per share? Rupees 10. This is precisely what EPS is. It's total earnings, which is profit after tax, divided by the number of shares outstanding. Okay, here my example was 110. So you finally get 10 rupees earning per share. Okay. And we have some related concepts to, one second, right. Okay, yeah, this is a very important, not so important concept actually. So when you delve deeper into the stock market, you'll come across these terms, basic EPS and diluted EPS. Basically, before moving forward with this, what happens is you have two structures, debt and equity. But there's also a form of financial instrument which starts off as a debt, but eventually, after some point, it can be converted into an equity. Right? These are known as convertible debt. Basically, you buy a debt instrument, and that instrument converts into an equity share after, say, 5 years. So it's no more a debt, it's a ownership in the company. Right? So what is basic EPS? Basic EPS takes only my debt equity, right? Whereas in diluted EPS, you also take into account the number of shares that will be totally present, taking into consideration the convertible debts also. Okay, right, the convertible bonds. So if you see here, we have PAT about number of equity shares. Here we have PAT about weighted number of equity shares outstanding, assuming conversion of convertible instruments, right? So if I say today I have 10 shares and say 5 years down the line, I know that I'll get 10 more equity shares from the convertible debt instruments. So I'll take 20 shares into consideration now. That's the basic meaning of basic EPS and diluted EPS. Understood? Take a minute. Just let this settle in. We talked about EPS, basic EPS, diluted EPS. Okay, so Okay, I'll re-explain. What is EPS? It's PAT upon number of shares, right? Now, if I tell you these numbers, in my example, there were 10 shares, right? So you divided rupees 100 by rupees 10, and you got 10 rupees earnings per share. But sometimes the company also issues convertible bonds. What is the nature of these instruments? Basically, they start off as debt. That is, you buy debt instrument from a company that you are a loan giver to the company, and eventually after 5 years of earning interest and being a debtor to the company, you become a shareholder. You become the owner in the company. So what is convertible bond? Convertible bond is something that starts off as a bond and then converts into an equity share after a fixed period. So when these debt instruments convert to shares, naturally the number of shares outstanding will increase for the company. Yes or no? Right? So when these number of shares increase, taking those converted shares into consideration, I will calculate the diluted EPS today. No, not ESOPs. Don't bring into consideration employee. I'm not. Let's not get very. That'll be like taking it too far. But just understand the shares outstanding. So ESOPs is basically what employees are given shares at a subsidized rate. So don't involve ESOPs here. Just see how many shares. So employees are shareholders. So just don't make a distinction between ESOP and the regular shares that are traded on the market. We're talking about total shares, including the ESOPs. Total shares that the company has in the market outstanding at a current point. Those shares are used to calculate basic EPS, and those shares plus those shares that will be converted 5 years down the line. Because the company is issuing convertible bonds, it knows that I issued convertible bonds in the year 2020. In 2025, those will become my equity shares. So the company knows that X number of shares will be my existing will be part of my existing shares 5 years down the line. So including those converted shares and what I have today outstanding in the market is used to calculate the diluted EPS. Understood? Okay, perfect. So this is basic EPS and diluted EPS. And if you're not understanding, just don't worry about it. Next, so now we finally start with the valuation ratios. Okay. 1 second. Okay, so the first ratio that we have is P by B ratio. Okay. And before moving forward, let's also discuss dividend per share. As we mentioned about EPS, EPS was what? Earnings per share. Now we have dividend per share. That's the dividend that you earn per share. The formula is annual dividend per share upon the face value. Okay. So utilization of profits, the company can either distribute dividends or it can retain those dividends, as I mentioned, because the dividends are not fixed liabilities of a company, right? The company may or may not distribute dividends in a particular year. And if it does not distribute, what does it do? It retains those profits for future for future. If the company wants to grow further, if the company wants to buy another plant, if the company wants to do anything else with those funds, so it can retain or it can distribute as dividend. As simple as that. Okay. This is not important. Okay, so now we finally come to the first ratio. Yes, understood. Diluted EPS basically if all convertible shares are converted, then what will the EPS look like? Exactly, Yog. I think you've put it in much better words. I was a little haywire. So yes, that's exactly what it means. So EPS is that amount that you earn per share, and those shares are what are outstanding in the market today. Diluted EPS is earnings upon the total number of shares, taking into consideration the shares that will be converted from these convertible instruments in future. Right. Now, the first valuation ratio that we move forward with is the price to book value ratio. Price is the market price per share. Okay. What is the price? Price is market price per share. What is book value? Book value is assets minus liability minus the intangible assets. Okay, so just write it down somewhere. You all should know this. What is book value of a company? It is total assets minus liabilities minus intangible assets. Okay, so try and reason it out now. If I tell you that P by B ratio is less than 1, what does that mean? If P by B, if my price by book value, price of the company upon the book value of the company is less than 1, what does that mean? Can I have more answers? If P by B is less than 1, just you just need to know the English meaning of these words. Right. So basically, if P by B is less than 1, in very basic terms, it means the company is undervalued. It's not a discount because that's not a So if P by B is less than 1, it basically means the company is undervalued. The price of the company in the market is lesser than the book value of the company. Right? So the correct word is undervalued. Right? Okay, so that is P by B ratio. So as it says here, if P by B falls, stock is undervalued. Okay. That is all that you need to know. Then we have P by E ratio, which is my second ratio. Okay. Okay. Now here we take price upon the earnings. Okay, so it basically draws relationship between the price of the company as opposed to its earnings, right, which is its profit. So if you see the ratio, it's market price per share, market share price upon profits in the previous 12 months. Right? So if my profits are high, I assume that the company is doing well, and so the market price will increase. So if my P by E increases, it means that the company is growing, right? I don't want to rush through it, but it's just that these topics are not very difficult to understand. So if there's any point you feel I'm rushing, please ask me to stop, please. So P by E, as I was mentioning, is basically drawing a relationship between the earnings and the price of the share. And if P by E is increasing, it basically means that the company is growing because earnings are growing and consequently the market price is also increasing. Generally, it lies between, like this ratio lies between 10 to 30. Okay. And that's all that you need to know about this ratio. Let me just ask one question, okay, here. If my P by E is 20, what does that mean? How would you explain a ratio of P by E equal to 20? Guys, if my P by E ratio is 20, what does that mean? Okay, take a pen and paper. Write P by E is equal to market price per share. So in these ratios, you can take per share values, okay? It'll be easier. So in the numerator, put market price per share upon earnings per share, okay? It's basically dividing the earnings upon the shares and also the market price divided by per share. So use the NPS and EPS in numerator and denominator. And if that ratio is equal to 20, what does that mean? So let me put in other words. If my P by E ratio is 20, it basically means for every 20 rupees that I invest in the company, I will earn a rupee. Or if I'm investing rupees 1 in the company, investing rupees 20 in the company, I'm earning rupees 1. Use maths to understand this. So P by E is equal to market price per share upon earning per share, which is equal to 20. So if my EPS is 1, my market price is 20, which is what? For every rupee that I'm earning, I'm paying rupees 20 to the company. Am I right? Are we on the same page, guys? Can I please have some answers in the chat box? If there's something that's confusing, I'll go over it again. I know I think this part is a little confusing. So I'll explain this again, but if there's anything else, just let me know. Okay, so P by E ratio. Okay, basically we draw a relationship between market price of the company and the earnings of the company in the current period. Okay, so everything here is talking about the current period. So in the current period, which is say about 12 months for this company, I'm comparing the market price of the company and the earnings of the company this year. Okay, I'm saying just take market price per share. So make everything per share. It's easier to calculate. So P by E ratio is equal to market price per share upon earnings per share. That's what we did before, EPS and market price consequently per share, just divide by the number of shares. If my P by E is equal to MPS upon EPS, which is market price per share upon EPS, which is earnings per share, is equal to 20. It means that for every 20 rupees that I invest in the business, I'm earning rupees 1. Or for every rupee that I earn, I'm paying rupees 20 to the company. Is it clear now? Write it down. I think it's going to be much more clear when you write down the ratio. Take EPS to the other side. So we have MPS is equal to 20 times EPS. Put EPS as 1. you get MPS is equal to 20, which means what? I'm earning rupees 1, but I'm investing rupees 20. Exactly what this is. Okay. So we have MPS upon EPS equal to 20, which means for every 1 rupee that I earn, I am investing rupees 20 in the company. Now, what can you infer from this statement? That is my next question, and it's very important to understand. What does this mean? If I'm investing rupees 20 in the company and earning rupees 1, what is exactly happening here? Guys, stay with me. If P by E is equal to 20, I explained it basically means that I'm investing rupees 20 for every 1 rupee that I'm earning. No, I'm not talking about profit or loss. What can you say about this investment? What is the nature of investment? What am I anticipating? What will happen? Okay, I think my question is not clear. I'll tell you what I'm looking for. Basically, when I'm earning rupees 1 for rupees 20 that I'm investing, it will take me 20 years to recover my investment. I'm anticipating that I'm investing 20 rupees today and I know that I will earn rupees 1. It means that it'll take me 20 years to cover my initial investment of 20 rupees. Right or not? Tell me. If my right, so I hold on to that thought. I will take this up, I think, after 2 slides. So hold on to this. It's very important, and I'm so glad that you got this. So basically, what does P by E mean? It basically draws a relationship between my investment and my earnings. If the ratio is 30, it basically means for every 30 rupees that I invest in the business, I'm earning rupees 1. So in layman language, it will take me 30 years to cover my initial investment of rupees 30. Are we clear here? Do we understand how to interpret this ratio? So if somebody gives you a P by E ratio of say 50, you should know how to interpret it and you should know what does it stand for. Okay, so Sarit, now that you've said that earnings will change, but I don't know how they will change, right? Like I know this is calculated for the current period. I know that I know the earnings for me in this current period. Now say I'm calculating P by E ratio for 5 years in future based on my current income. How will I do that? My question is P by E ratio is calculated for the current period. So I know the current market price. I also know the current earnings for my company. So I can easily calculate P by E. Now, if say I'm calculating this ratio for 2 years hence, and I'm using the figures from today, like the basis for calculating 2 years hence figures is today's figures. Is it right or not? And if it is not, what can change and how? Think about this. I have to calculate, and there's no chance of not predicting. आप predict किसी चीज का भी कर सकते हो. You can predict anything in the world. So as a company, I want to predict the P by E ratio of 2 years into the future or 5 years into the future. Is calculating P by E sufficient for it? Can I, if so today say I have P by E as 10, can I say my P by E will be 10 all the years hence? That is next year it will be 10, next year it will be 10, third year from now will also be 10. Can I say that? Is it a rational prediction? Exactly. Growth factor has to be taken in place. Yes, it can reduce also. It can reduce also. It can increase also. So if I'm saying my P by E for the current period is 10, and that it will remain 10 for the next 5 years, it's not a rational prediction. I will have to take into consideration the growth factor, which can also increase, which can decrease. It can increase at a higher pace. It can increase at a lower pace. Anything can happen, right? So what we do in that scenario is that we calculate. We'll come back to these slides. We calculate price to earnings to growth ratio. One second. Yeah, that's what we are looking for. Okay. So what happens is, what we do is, to make a rational prediction, we say that we take into account the growth factor. And here growth can be anything. The company's growth, that can be economy's growth. Because a lot of times what happens is a company's growth is also linked to the economic growth. So if the economy overall is doing well, the company is also doing well, and vice versa, right? So what we take the growth factor also into account, and hence this ratio is formed, price to earnings to growth ratio. It's same P by E, but you also take expected growth. So if you see these examples here, P by E is 30 times, growth rate is 20%. What is my PEG? 1.5. From 30, it reduces to 1.5. If PE is 20, growth is 2% only. My PEG is 10 times. Do you see the difference? Earlier, we thought that PE of 30 is more than PE of 20. But once we take growth into consideration for these two companies, we see the scenarios reversing. Do we understand this? Its significance is basically to have a rational prediction. If I say that my PE is 30 today, and I say that it will remain 30 for the next 5 years, it's not a rational prediction now. I'm saying my economy is growing at 20% rate. So it's rational for me to assume that my company will also grow by a factor of 20. Or I can say it increase by 15, whatever the company's policies are. But we'll have to take into consideration the growth factor also, and that is why we have this ratio.
Hi, Muskan. Sorry to interrupt. Hello.
Yes, Sanjay.
Ma'am, can you just explain this, which is written PEG, PG is 1.5x is cheap and 10x is expensive.
Okay, so when I was talking to you about PEG equal to 20, what did we say? What did we mean when we said it was 20, that I'm paying rupees 20 for rupees 1 earning?
Right.
Now, when it is 10, it basically means what? Reason it out. Now you've taken the growth factor into consideration. You don't have to use that in the explanation. So PEG is basically my price earning ratio, taking into factor the growth. So if your PE now is 10 as opposed to 1.5, what does that mean? Like the case that we have, that PE is equal to 20, which means I'm paying 20 for rupees 1. What does 10 and 1.5 mean here? Hello?
It would be easy if you'll give an example. Like I to understand it, but for the class I'm saying as like PE 30 है तो growth rate.
One second. Don't talk about the class on your behalf. That's a little taking it too far. I'm saying PE is equal to 20. I gave you an example. PE is equal to 20 means that I'm earning rupees 1 for every 20 that I'm paying. Explain me what does 10 and 1.5 mean?
So for every 10 rupees, I am earning 1.5.
Baba, these are two different ratios. How are we comparing 10 and 1.5? What does, so when I'm saying PE is equal to 20, it means every 20 rupees that I spend on the company, I'm earning rupees 1. So what does 10 mean? Tell me what does 10 mean?
Confusing.
It's not confusing, Are. Why is this confusing? Okay, take a pen and paper. Take a pen and paper. Write what I'm saying. PE, P by E is equal to, one second, let me use an Excel. 1 second. Let me know if you can see my screen.
Yes.
Okay. Okay. So I'm saying P by E is equal to market price per share upon earnings per share. Here. Now when I'm saying my P by E is 20, what does that mean? That MPS upon EPS is equal to 20. Right?
Yes.
Can I take MPS, EPS on the other side? So it'll be 20 into EPS. And now I'm saying put EPS equal to 1. What will you get?
20 MPS.
So what is it? 1 rupee is what I earn. This is what I spend. So PE equal to 20 means what? For every 1 rupee that I'm earning, I'm spending rupees 20.
Correct.
Now when my PE is 10, what can I say consequently? Again, do this calculation. Do this. Write it down. You'll understand what does 10 mean. So it's like saying that I'm giving you rupees 1 and I'm taking rupees 20 from you. You are getting an expensive bargain. Yes or no? मैं आपसे 1 रुपया आपको 1 रुपया दे रही हूँ और आपसे 20 rupees ले रही हूँ. So you're basically giving rupees 20 but earning 1. Is it expensive or not for you?
Expensive.
Right? Similarly, what does 10 mean? 10 means that I'm earning rupees 1 but I'm spending rupees 10. And for 1.5, it means I'm earning 1 but I'm spending rupees 1.5. In comparison, is this more expensive or not? Tell me.
20 is 2.
Take a minute. Okay, take a minute. Everyone, please take a minute. Think about this calculation.
So one is 20:1 and another is 10:1.5, right?
No. Oh, now I see where the confusion is from. This is for two different companies. This is company X, this is company Y. Company X is calculating PEG ratio for itself. Company Y is calculating PEG ratio for itself. So I'm saying your company has PEG ratio of 1.5. My company has PEG ratio of 10. So like your company has PE ratio of 1.5, my company has 10, and some third company PE is 20. So these are three companies, 20, 10 and 1.5. So for the company that PE is 20, basically means I'm earning 1 for spending 20. For my company, I'm earning rupee 1 but spending 10. And for your company, I'm earning 1 for every 1.5 I spent.
So the company is the most expensive.
Yeah, this 20 wala company is the most expensive. And this is least. Is it clear?
Yeah.
Guys, anyone else who is facing issues with this calculation, let's try and reason it out to yourself. So it's like I'm giving you anything worth rupees 1, but taking something from you worth rupees 20. This is exactly what it is. EPS is earning, MPS is market price per share. This is what you pay if you buy a share for a company. Yeah? So you're spending rupees 20, but getting only 1 rupees in return. So it's expensive bargain. Please type in yes or no if you've understood it. Guys, can I please have some responses? Have I lost you all? Do you want me to repeat this entire topic? Where are we?
We can go ahead.
I'm waiting for a few responses in the chat box, honestly, because I don't want to rush through this topic. Guys, can I please have a few more guesses? Because there's a lot to cover.
One small request.
Yes,
One small request. Can we take some real life example to find out what is PE ratio of one or two companies and how they have calculated it?
Yes, of course we can do that. I'm not sure we can do that today in today's session. Perhaps the next session for sure.
Okay.
Okay. So we did P by B, we did P by E. Then I'll share the slide with you so you can read through these points. I've discussed all of these. So there's no point going over these again. Price to earning, we have drawbacks, rationales. One of the drawbacks that we consider for PE is we do not take growth into factor, right? And that is overcome by the PEG ratio. So before moving with enterprise value, anything that is not clear with PE and PEG ratio? Quickly.
Ma'am, I have a doubt. Can you go back to the slide where there was an example of Google and Coca-Cola?
1 second. It was in PEG, na?
I guess PE. Previous.
Yeah.
Yes. So can you just like I don't understand this arrow of fast growing companies, it's going up and the mature companies. It's going down.
Okay. So, okay. See, if I'm saying, let's take a similar example. Okay, PE is 20. You know, what did that mean? Ki I'm earning rupees 1 for 20, as opposed to some
Right.
company jiska ratio is 5. So I'm spending rupees 5, but I'm earning rupee 1, right? Or I can also, okay, 1 second. If this is 20, 1 second, on spend, and let's take a case of 5. Okay. So when the PE ratio is 20, I'm earning 1 for every 20 that I'm spending,
Hmm.
right? This, right? So I'm earning 1 for every 5 rupees that I'm spending with PE equal to 5, right? I can also write this 5 as 20 and this as 4, just multiplying by 4 throughout. 1:5 को into 4 किया तो 4:20 आ गया. I just want to get these amounts same. So if I'm spending rupees 20 in company A, but I'm earning rupee 1, whereas in company B, I'm spending 20, but I'm earning rupees 4. This is a faster growing company.
Okay.
This is a matured company. Exactly what they've written there. बस आपको उनको एक कंपेरेबल स्टैंडर्ड में लेकर आना पड़ेगा. जैसे यहाँ पे पहले 1.5 था, that can also do the job, but it's better to understand from the amount that you spend. आपने 20 rupees spend किया तो आपको earn हुआ 1 rupee, 4 rupee. 4 rupee इसलिए earn हुआ because the company is a faster growing company. ठीक है.
Which means matured companies की P generally down रहती है to growing companies.
As compare, yeah, because obviously ना देखो, अगर एक कंपनी जैसे रिलायंस की कंपनी इज ग्रोइंग अभी, है ना, उसका शेयर प्राइस भी इंक्रीज हो रहा है. क्यों इंक्रीज हो रहा है? क्योंकि अर्निंग्स ही ज्यादा है ना, हमें पता है कि डिविडेंड ज्यादा मिलेगा. यहाँ कंपनी ग्रो कर रही है, प्रॉफिट ज्यादा हो रहा है, तो वी कैन एक्सपेक्ट कि डिविडेंड ज्यादा डिस्ट्रीब्यूट होएगा, एज अपोज टू सम कंपनी जो अपने सैचुरेशन पॉइंट पे पहुंच चुकी है. ग्रोथ पोटेंशियल नहीं रहा ना, तो ग्रोथ नहीं होएगा अगर, तो प्रॉफिट नहीं होएगा, तो मतलब डिविडेंड ज्यादा नहीं मिलेगा, मतलब अर्निंग ज्यादा नहीं मिलेगी, एज कम्पेयर टू अ कंपनी लाइक रिलायंस जिसमें ग्रोथ बहुत ज्यादा है. प्रिसाइसली दैट.
Okay. Got it. Thank you.
Okay. So let's move forward. We were on enterprise value. Okay. So one concept again that you need to understand is what is enterprise value. Before moving forward, do you guys want to break in, like for a small break or something? I'm not sure if you're studying since a long time. We've had 2 hours of session. I was suggested that I take a 10 to 15-minute break. So if you guys are interested, we can stop for 10 minutes and then continue. Okay, so it's 6 in my clock, 6:01. So let's meet at 6:10, 6:15. By 6:15, everyone should be here. I will start dot 6:15. Just waiting for everyone to settle in, and then we can start. Hi, so is everyone back? Can we resume? Okay, so I see people joining in. Okay, guys, before we move forward, I really feel that PE, PEG wasn't that clear. So if there's any doubt, if there's anything that still persists, we can go over the topic once again. So just let me know.